Federal Reserve was the big headline all week long. And what did they do? Absolutely nothing, except they did say they're probably going to hike one more time. Wall Street doesn't want to hear it. We're hearing about the higher for longer narrative. They're done with it. Stocks had the worst performing week since March. Is the selling going to continue? Some say yes, but we're not sure. So we're here to answer everything for you today. And we have a very special featured guest with us. He has been with CNN for over 20, or was with CNN for over 20 years. But what he's doing now is even better. Paul LaMonica is joining Buy, Hold, Sell. Paul, welcome to the program.
Thank you very much for having me. Appreciate it.
Paul, and of course, with me is Tobin Smith.
Yeah. Well, first off, Paul, understand that Todd did take a little speed this morning, okay? And then when you throw down some coffee, so I just don't want you to be shocked and think that this is what the normal Todd Schoenberger is.
It's all good.
I'm
always caffeinated. By the end of the day, though, it wears off. I'm usually a water and diet ginger ale guy post lunchtime.
Yeah,
so
I'm calming down with the grapefruit soda right now.
Yeah,
right,
there may be bourbon in my future after we tape this, but not while.
Absolutely.
Exactly.
And I think the audience might be thinking the same thing, because after this week that we just had, Paul, I gotta say, I mean, the Wall Street traders do not want to hear the higher for longer. You had a very great piece that went out on your Substack, and you're talking about similar thoughts, but what do you think? I mean, are we going to see any type of a turnaround in the markets in the near future?
Yeah, I mean, it is worth pointing out that despite all of the historical market crashes in October that we've had over the years and a lot of the volatility, September typically is the worst month for the market. So it shouldn't be a big surprise that we're seeing this downdraft right now. The big question, I think, for investors and traders going forward really is how quickly do they adjust to this higher for longer narrative? Is there going to be another rate hike in November, in December? And then what does the Fed do in 2024? I think rate cuts that were starting to be priced in might get pushed out to later in the year, maybe even 2025 if inflation continues to be a major problem.
Yeah, I think you might be right about that. Toby, we talked about this yesterday. I mean, right now, it doesn't look good. There's a lot of pressure on the downside. You have the UAW strike. You have a potential shutdown with the U.S. government. I mean, what else can go wrong right now? I mean, what do you think? Are we going to get out of this and start the fourth quarter on a high note?
I mean, first off, it seemed like there was two camps on Wall Street for a while there, and one camp was severely delusional. The delusional group is, oh, yeah, not only do we get a soft landing, but we're going to start cutting rates. And that's not literally possible because, if you actually opened a book or something or ever did any math, I guess we don't do that anymore. We call, TikTok and ask what's going on. The structural strength of the top 20% of these households that are responsible for almost 80% of discretionary spending, that's up. I realize credit card, defaults are going up. I certainly realize that, repossessions of cars are going up, but they're going off a very, very low level. And let's be honest. When a Ford 150 costs $65,000, the same truck that somebody bought for $20,000 years ago. I mean, not everybody can afford a $1,200 payment. That was the average payment last month. So then we have, I always talk about the 63 super counties in the United States that also account for 75%. If you look at their unemployment rates, they're below the national unemployment rate. I mean, we still have 2 jobs for every 1 person available. So the idea that, number one, that we could go back to 2% inflation as the target when the world today is completely different. All of that disinflation we had, since China came into the market, that's going away. Deglobalization, energy, but mostly deglobalization, reshoring. We can't all, Mexico's now the largest exporter of the United States. They can't send us any more shit. I mean, it's just, it's not going to work. So that's the conundrum, because the conundrum is, by the way, the Fed is selling $95 billion of bonds into the marketplace. Right, Paul? Whatever. Everybody wondered what was going to happen when we went to quantitative tightening. Well, I think we're sort of seeing part of that. the world can only buy so many of our 10-year bonds. We are going to run a $2.4 trillion deficit in the fiscal year. So that means we got to sell another 2.4. And then, so I think reality now has started to catch up with the actual market. And then on top of everything else, like, dude, when you have a 5.5% 10-year bond, and you discount the present value, of the future earnings of the Magnificent Seven, which up until 3 weeks ago were 96% of all the gains in the market, something had to give. And so I don't know, what was it that, here's my other one quickly, Paul, that really gets me. When I was started on Wall Street as a bond guy, we raised rates, Volcker did his thing. But at that time, the United States had a $3.5 trillion economy. We only owed $240 billion. Today, we're at 143% debt to our GDP, and we still have to borrow. And Japan is not going to buy anymore. China's certainly not going to buy anymore.
No, China's definitely out of the picture at this point.
Who the fuck are going to buy these bonds now? And that's what's getting priced in. There's too many bonds for not enough buyers. And when you can lock in, pension plans that I work with, they're looking for a 7-8% annual yield. That's all they needed to get to their point. If you can lock in 5.5% on your bond, and bonds eventually go up in value because rates go down, why do you need stocks?
Well, I'm going to push back real quick on that one, Paul. Sure. I mean, interrupt you, but you still have yields that are shooting higher. We see the 10-year yield. It's actually the highest it's been in 15 years. Yeah, Katie Stockton on buy, hold, sell. She's actually predicted a 5.25% yield on that 10-year. I mean, if that's the case, and you have selling pressure that's taking place in the market, that's who's buying the bonds. The equity investors, they're moving more into that fixed income side. You are right, though. Once rates start to drop, there's all kinds of issues you have to start thinking about. But,
and I think you're definitely. Yeah, I think you're definitely seeing with bond yields finally resembling something that is closer to normal, being attractive for someone that wants income. Obviously, REITs, utilities, there have been troubles there. The thing that concerns me, particularly with this soft landing narrative that is starting, I think, to finally fade is exactly. Is that who didn't buy a house already, rates were low, is going to be able, especially if you are someone who is not in a position to sell something that you bought that was inflated during that great period when prices were appreciating so rapidly. You might still be able to sell something now and buy something, but why would you want to do that with mortgage rates where you are? But a first-time home buyer, that is not in the cards with rates where they are right now. And I think that is certainly, something that is troublesome. I don't believe that we're going to have another 2008 event necessarily, but we saw some of the stress with regional banks earlier this year, with First Republic needing its Jamie Dimon bailout, and Signature and Silicon Valley. I mean, again, I was around for 2008, worked at CNN, remember Lehman weekend, not fun times. And I don't think that's going to happen again, but people are being way too optimistic if they think that financials are going to come out of this looking just fine, especially since, by the way, all of those too big to fail banks from 2008 are too bigger. I mean, how big can JP Morgan, Chase, Bank of America, Citi, even Wells, because Wells bought Wachovia in 2008. They were giants then, and now they're behemoths.
Yeah. Well, Paul, I would also, point out, for some reason, I tell our subscribers and money management clients that what would really be great is you could take the little pill and just forget about 2010 through 2022. In other words, with zero and negative interest rates, there really was, Tina, there is no alternative. There was 5 trillion, excuse me, what I'm trying to say. There was 15 trillion pumped into the monetary systems. Has any of that come out? No, it's still there. It's got to go someplace. It's just finally, people say, well, Christ, I'm not going to put it in a bond and make a 2-year return. I'd actually lose money in the bonds as interest rates go up, which they did. I mean, I think people forget on this 60-40, traditional portfolio in 222, they were down 30% on their stocks. They were down 28% on their bonds. I cannot remember a time other than 2008 when something like that happened. So if you forget about Tina, if you forget about zero, if you forget about the Fed, you forget about monetary policy, and just go back to sort of what's normal. There's financial gravity. And when interest rates on the 10-year risk-free go up, financial gravity pushes equity values down to a point where they're relative to each other. Retail investors don't sit there with a discounted present value model and say a click or do this. But here's one other thing you got to add in. When I ran mutual funds, this is the time with your October 31st fiscal year end for active mutual funds, not ETFs, but for the actives, where you basically sell, a lot of take your profits on your good stuff and you match it against your losses. So that way your shareholders don't get, taxes, right? So we had this, AI craze, and, NVIDIA's up 264% at a time, blah, 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 blah. C3 AI, which doesn't have any AI, is up, 180%. So it's very natural at this time for active money managers to be cashing in. As I always like to say, the stock market since 1959 has returned about 7.5%. If you get 40 years of gains in a 3-month period, and you're a money manager getting paid to do this, if I didn't take gains, my little ass would be on the street. I'd be Aaron Rodgers. I'd be running down the field, and then I'd be lying on the ground. Okay, so that's natural now. But what's the incentive to be buying the dip? And I'll go into just the charts very quickly, saying that now every technical that I have says that we have to sort of go back to the 200-day moving average on the S&P 500 just to shake out all the new money.
Right. Well, as a Giants fan, I don't take offense at the Aaron Rodgers joke. We just can't mention what happened on this past Thursday night. Everyone's going to be getting ready to watch their favorite football team later today on Sunday. I'm glad that my misery is already over.
Well,
out of the way.
The people who are on the podcast, he's wearing a green shirt. Okay, so
before we go to the break, Paul, quick question for you. So you have probably a extremely it's platinum Rolodex. I mean, if you have with all the contacts you were a writer for the CNN for over 2 decades. You clearly know everybody on Wall Street, writing about Wall Street issues. The overall, over the last, say, 12, 18 months, what has been the vibe from some of your contacts? I mean, have they been negative? Are they thinking, okay, we are going to be heading into a recession? Or is everyone saying, you know what, I think everything's going to be okay and we will have that soft landing?
Probably something in between. I mean, I don't know that many people who are concerned from a 2008-ish type of level, because I do believe that it is good news that the big banks, for, if you want to give credit to bank executives for being more prudent and not taking on as much risk, you could thank maybe Dodd-Frank and some of the regulations that were put into place, even though a lot of people think that Elizabeth Warren is public enemy number 1 on Wall Street. So I don't get the sense from people I talk to that another apocalypse is coming, but there is definitely more caution. To Tobin's point before, you don't get these types of gains in such a short period of time without having pullbacks, call them corrections, bear markets. They don't have to be so much bloodshed to scare people out for the long term. But, people I talk to are definitely more concerned, especially since we've had this mentality with retail investors. And I'm not going to go out and say that all of the quote unquote apes out there don't know what they're doing, but what we've seen with the likes of GameStop and AMC in the past couple of years, yes, it's kind of fun to empower the retail investor and stick it to the proverbial man and watch
Yeah.
these hedge funds and other institutions that have shorted companies that maybe they didn't totally understand get their comeuppance. But, let's be honest. I mean, good old fashioned buy and hold value investing shouldn't be dead. I mean, you do need to look at earnings, look at a balance sheet. Companies that are highly leveraged, especially with rates going up right now, don't deserve these types of valuations. So I am a little worried, like many of the people I talk to, that this has been too far, too fast with regards to this bull rally this year.
Well, there you go. I like that. Well, Toby, let's leave it there on this block because because coming up after the break, Paul has a very interesting take on the UAW strike, and he actually is saying it might be good news for auto stocks. But we'll get into that with him after the break. So please stay with us.
Girl, you know it's been way too long. I got to get back in my zone.
I mean, yeah, let's talk about today we're gonna go topics.
Roll it down.
I am.
You don't need a car to listen to Sirius XM. You can listen anywhere. You know that, right?
What? Kevin Hart's Laugh Out Loud Radio.
Kevin, you could use your phone.
What? What?
Alexa, play Kevin Hart's Laugh Out Loud Radio on Sirius XM.
What?
This is how I know you're getting old. I guess that was it.
What does it mean to be a leader?
It's taking my first solo flight.
At the University of North Dakota, we lead our own way.
Higher for longer. Well, Wall Street definitely did not like it this week. We actually saw the Dow have the worst performing week since March. It was up almost 3%, I'm sorry, on the week. And that actually brings the loss going back to August 1st. We're down 4.5%. Not good if you're an equity investor and you were thinking, okay, this thing's going to just keep running. But we have a very special guest with us. Paul LaMonica is staying with us right now. You probably know him as the featured business editor over at CNN. He was there for over 2 decades, and now he's on to bigger and better things right now. We're really happy that he's taking the time to join us today. Paul, I got to ask, though, when is this bottom going to hit? Because we have had a number of Wall Street celebrity-type guests, just like yourself, that have been on buy, hold, sell, and they came right out and said August and September, we're going to be down months. I don't think anybody anticipated it being this bad. But what do you think? Are we going to see that bottom anytime soon? And if so, when?
Yeah, it's a great question. If I knew definitively the answer to that, I probably wouldn't be telling too many people. But no,
Don't
honestly,
wuss out. Paul, do not wuss out.
I'm not wussing out. I didn't get there yet. So I don't that we are going to hit bottom in October, because I still don't believe that investors have priced in just yet the likelihood that there will be one more rate hike probably this year. Inflation has not been defeated to Jerome Powell and other Fed members' liking just yet. And I don't believe that investors are factoring in earnings for the fourth quarter maybe not being as healthy as they had originally expected. And then 2024, everything is in question with regards to what earnings growth is going to be like. So until there's more certainty, I don't think we bottom until maybe later this year, when Tobin's probably going to laugh and screech at me for bringing up this hackneyed little thing. But the Santa Claus rally that
Hey, there we
everyone loves
go.
to talk about. Hey,
Love
once
a
a
Santa
financial
Claus rally.
journalist, always a financial journalist. If we
Yeah,
can
right.
talk about something as cheesy as the Santa Claus rally, we will do so.
No, it's
Yes,
not
but
cheesy. It's
It's
not
not cheesy.
cheesy.
no,
And
I
it's
mean
real.
it's not cheesy because it is based in
Real.
facts and
Yeah.
real
Yeah.
numbers. But
Well, it's I mean, listen, we have Jeff Hirsch on all the time, and he's been all over this since I knew his dad, for crying out loud, 40 years ago. But just as I said, in the mutual funds that are now taking profits on stuff that's up 50, 60, 100, 200%, because that's what a normal money manager should be expected to do. Conversely, as you get into the later part of the year, then the stuff that's still up, you add to your book. So when it closes on December 31, it shows you what you have. So that's the mechanics of Wall Street.
right.
I'd go a little bit differently here. I mean, 4,200 is that long-held support for the S&P 500. Yet, as we all know, 7 stocks represent more than about 58% of all that value. Okay, the air has to come out of the AI bubble. It was one of the fastest gaining bubbles I'd ever seen. It has to come out because that shakes out the weak hands. I love a lot of metaphors on Wall Street, but weak hands and strong hands really, tells me the weak hands are just simply people. Remember, 72% of the trades are by algorithm, by computer. So when something's going up, they're buying it. They don't even know what they're buying. They're buying it until it goes down. Then they sell. So we're in that sell part now. They'll try to make a stand at 4,200. If it doesn't, if the 200-day breaks, then next one's 3,800. And I would not dismiss the idea that we got so far. Every hackneyed metaphor I can use, we got so far over our skis. We got so far ahead of ourselves that you got to take that air out of the balloon. And so I'm looking more like 3,800. Now, in between that, we have some sectors that we're doing very well in.
Hold it, back up. Are you saying 3,800 in the S&P 500 this year?
Yeah, is your headphone on, or I mean, what are you doing?
I just want to make sure I got that right.
Paul, you got to understand, Todd Schoenberger could be at the Chicago massacre and still come out positive. He'd say, "Yeah, but there's like 6 guys who didn't get killed."
Well, we had Ed Dr. Yardeni. He has 4,600. Now you're at 3,800. That's a big wide margin.
But Ed just changed his stuff this week, so you should get out of whatever that box you're in.
I'll go to this thing. I'll go to Google.
Go to this Google thing called Google. Yeah,
Google.
So again, we need the market, since it's primarily traded by machines. When we get to the point that it doesn't go down, then it doesn't go down again, and then maybe we get a surprise in on something, blah blah blah. Then you certainly have the Christmas rally, and that makes sense. I'm just saying that the actual on volume traded, it's at 3,800 where you have a lot of people in there, and so they're not losing money until they get to 3,800. Therefore, they'll sit on their hands just to stay with the thing.
Paul, any thoughts on I mean to interrupt you, Toby. Any thoughts, Paul, on the fact that we're in a pre-election year? I mean, wouldn't the idea that Biden and the administration, they don't want to lose power, so therefore they're going to do whatever it takes to make sure that people feel good, they feel a little wealthier? Wouldn't the idea that you'd see so much money juiced into the economy to try to keep stocks propped higher?
It's possible. I mean, there's only so much that obviously the executive branch can do. I mean, clearly, I mean, we've had a lot of executive orders in the past couple of years with the prior administration, and I think continuing into now as well. I think the bigger issue, considering that there are concerns about a possible government shutdown and what that's going to mean, I think, investors should price in dysfunction in Washington, regardless of which party is in power. I think that is something that clearly is just getting worse and worse, this polarization that we have right now. And I don't want to get too into the political weeds, but, it definitely seems that moderate politicians are kind of akin to the dodo and dinosaur and other extinct animals. You either need to be far left or far right to get through the clutter. But that being said, the thing that I am wondering is, when are we going to start to see, for all the talk about the economy losing steam potentially, we still haven't seen it at all in the jobs numbers. And I know that the jobs numbers are very lagging indicators, but eventually it's going to have to see, we're going to need to see some weakness. I mean, we just got what? 204,000, if I remember correctly, on jobless claims. 201,000, even lower. So 201,000 on jobless claims. We've yet to have a serious deterioration in the payroll growth. So as long as that happens, and if wage pressures remain high-ish, I mean, wage growth has slowed, but again, not so much to really take inflation out of the equation yet. Hence, Jerome Powell is still flapping like a hawk instead of a dove. I mean, I think there are still a lot of variables here that do make me worried that there could be some more downside for the foreseable future, because I just don't think investors are pricing it in yet.
Do you remember way back, like yesterday or on Wednesday, when Jay Powell looked into the camera and said, "Are you morons listening to me? It has to be longer than you are, putting in the futures market." I'm parenthetically on that. There's no freaking way that we're going to cut rates, because we have to eliminate jobs. And the way you eliminate jobs is to slow the economy down to the point that at the margin, you fire people. I'm not talking about handsome, writers at CNN. I'm talking about, the everyday folks. And the crucible question still remains, which has been buried for the last 6 months, is, do we have to get a recession to eliminate enough jobs to get to the 2.0? And for a while there, I was unsure. Now the math that I do says it is freaking physically impossible with two jobs for every one person, to get actual recession in or do it and have this soft landing. Soft landing to me was a pipe dream, and now they've smoked all the taupe. It's like hopium. There's one or the other. If the Fed comes clean and says, with the deglobalization, because remember, globalization is why we had such low inflation rates for 25 years. Now that that's in the dustbin of history, we have to adjust our inflation number because we don't have any of the deflationary parts out there. That would be one. But everybody thinks if they do that the bond market will literally shit the bed, because now they've broken their promises. So the only other way they get to 2%, I can't do the math any other way, that you have to destroy about 400,000 jobs. And we're not close to doing that. Oh, we got to invite another 400,000 Venezuelans in the United States and give them the work permits, right? So that's the mystery, and that's the question. And right now, the math to me says that they have to create a recession to generate the jobs, so that we get rid of those jobs, so that prices comes down, wages. Because remember, shelter costs is 42% of the whole freaking CPE. Energy, we already got rid of all the oil we ever had in the SPR. So that was how that worked out, Joe. And so there's no other levers to pull. So, well, okay.
So does Powell have to be even more spoken and more negative? I mean, we finally have a Fed chief that, for better or for worse, usually speaks in a plain-spoken, not coded manner. This isn't the days of Alan Greenspan, where I used to joke that probably Andrea Mitchell had no idea what the heck he just said, and they've been married forever. Ben Bernanke, the subprime mortgage crisis was likely to be contained until it wasn't. And then Janet Yellen, I mean, she was only Fed chair for such a short period of time before, now becoming Treasury Secretary. It's almost difficult to really, give a track record for her, even though she was under the, with the Bernanke regime for a very long period of time. But Jerome Powell, finally, the Fed has someone who isn't speaking in code. And again, that now seems to be a problem for Wall Street.
Yeah. Well, you are right about it, but he is somewhat direct. I mean, he has come out and said, we're going to shoot for 2%, no matter what anyone says. The media gets the talking heads, the financial channels, they get the talking heads on saying, oh, the Fed's going to cut, they're going to do this, they're going to do that. He came right out and said, no, we're going to keep going until we hit 2%. But we're not even close to that. And it's a long road to go from 3% to 2%. And you can't just say, oh, yeah, we're going to have one more rate hike of 25 basis points, which is not going to move the needle. Toby is right. You have to really crush the economy. However, you're coming up on an election year. And that's not going to happen.
Yeah. So that's been my whole thing, too, is that after 25 years in Washington, D.C., rule number one, you don't screw the pooch economy during a re-election year. So I understand, that why. But he's just going to be dancing like a marionette here then for the next 9 months. But he just got fed up. He looked in the camera and he says, listen to me, read my lips.
Mission accomplished.
It's higher for longer because we're going to, God damn it, get to this 2% unrealistic goal. So to me, these are two separate. The conundrum is that this is like there's a really good word for it I can't come up with. It doesn't make any sense, and yet he continues to stomp on the and people are going no.
There is this willful
cognitive dissonance. That's the word I was looking for.
There you go.
I didn't want you to correct me, Paul.
No. No, there is this willful sort of ignorance right now. But I do wonder, despite what the Biden administration clearly would want for their reelection chances in 2024, despite what Democrats in Congress, Republicans in Congress, whoever the Republican nominee is going to be, it's starting to look like it's going to be a repeat of the 2020 election, but there's still a lot of time to go. The question I have is that Jerome Powell has to do what's best for the economy, especially if he's now having gotten to his second term. He might be at a point where he's not going to be sticking around as Fed chair. He may not have his butt out the door yet, but if he's like starting to have sweet dreams of brooking sugar plums dancing in his head or some other think tank, he may not be in a position where he can say with political calculus, I can't do this because it's going to mean this for the presidential election, mean this for the White House, for the race for the White House, for what's going to happen in Congress. Because remember, I mean, 2020 is a weird situation because you can't say it's just the economy that led to Biden's win. I mean, we had the pandemic, a once in a lifetime type event. But go back to 1992, and we all know that there is a probably significant reason why George H.W. Bush was not a two-term president. It was the taxes, but also Alan Greenspan, wasn't worrying about politics. He was worrying about the economy. We did have a recession, and I think that was a big reason why, 92 happened the way it did.
When you say that, Richard, and you say that, I was elected simply because of Greenspan, it hurts my feelings.
Oh my God.
It's very good.
That's my Clinton. That's the best I can do.
I knew. Very good. You just need a McDonald's cheeseburger with you. So, all right, let's pivot off of that. So, Paul, you wrote a very great piece, a compelling piece on Investor Place. So welcome the audience to go to investorplace.com, check it out, because you are talking about the UAW strike. You actually think that this might be good for stocks, for the auto stocks. Can you explain?
It's possible. I mean, I think what is very interesting, and I based this on a report from S3, a research firm that does a lot of looking at what's going on with heavily shorted stocks. They pointed out that GM, Ford, Stellantis, the Chrysler owner, that they are among the more heavily shorted stocks in the auto industry right now. Tesla is by far the most shorted. It's actually the most shorted stock, period, on the planet. And you can get into whatever reason you want for that. But what's interesting is that because there are so many bearish bets on the big three right now, it is altogether possible that whenever the UAW strike ends and things return to normal, auto sales, which haven't exactly fallen off a cliff, by the way, pick up even more potentially, that is something that could create the proverbial short squeeze where people rush back in and buy these stocks that have been shorted. So I think there is the possibility that there's too much negativity about the auto industry right now. But obviously, a lot is going to depend on just what happens with this UAW strike and how long it lasts, and when it really starts impacting production, and of course what consumer sentiment looks like next year with the Fed still apparently raising rates is of course another big question.
Yeah, but I mean, let's just bear in mind quickly that the market cap of Tesla is 2 times larger than every other auto all put together.
Yes.
So on a relative basis, the auto industry stocks, whether they pump up in a short squeeze, it doesn't affect the Magnificent Seven that are the 92% of all the gains. So I would disagree with you on that, Hanson. But it is intriguing that you look at service wages and the rise they've had, and that's a big part of inflation.
Yes.
There's no unions in the services business except for in the hotel and the other in the hospital and that sort of stuff. The one that's bigger to me is the hospital strike. That's a big part of our economy. That's and if Kaiser people just walk out, you're going to see the other union, and they should be paid more for Pete's sake. But the only chance we had in October for inflation to come down is that was the highest part of the shelter bubble. And on a year-over-year basis, we were supposed to have prices come down enough, so that would really bring the core number down. And yet, we just had prices rise in 6 out of the 10 districts. So other than San Francisco, you're on your own, buddy. But
you're right. Well, we had Dan Ives on Buy Hold Sell about a month and a half ago, and he just recently published a report talking about this strike. And he said if it goes 4 weeks, it's going to have a mild impact on the economy. If it goes 6 weeks or more, it's going to have a great impact. And the reason, quite negative impact, but mainly on the EV side. So you're going to have a lot of these cars that will not be, these manufacturers that will not be able to produce those EV units going into 24, maybe even 2025. So that's a big issue right now. Biden, we actually just got breaking news. Biden did announce that he's headed to Michigan. He's going to get involved in the talks.
Oh, geez, I lost my bet. I bet against Joe Biden going to stand with the.
He's going to Michigan. I don't know when, but he just announced he is going to be heading to Michigan for this, to have, I guess, to try to bring all the sides together. And he's going to have that Lee Iacocca moment, I guess. So we'll see how it happens. So who knows? So listen, we're going to leave it there, guys. So Paul, how can the audience find you?
They can find me at my Substack, Rational Exuberance. So they can check that out if they use the Google and search my name and Substack. I am writing a little bit for Investor Place. So you mentioned very kindly that article about the big three and the short interest. So
and Paul, you undoubtedly know that I founded InvestorPlace.com. I did.
Look at you, Toby. You guys, you're amazing. Toby could have been your boss.
There we go.
No, that would have never happened. I only hire people stupider than me. It's always worked for me. Okay. So
and we will also, on all of our social sites, as well as in the description of all of these shows, we'll have links directly to Paul so you can track everything that he's writing about. Definitely want to go to investorplace.com. He is a contributor there, and I know he's on the bigger and better things as well. So we can't wait to see hear about your next stop, Paul. I know it's going to be awesome. So and we definitely can't wait to have you back on the show. So thanks again for joining us today. And
Thank you.
Thank you. And on behalf of Tobin Smith and TobinSmith.io and Paul LaMonica, I am Todd Schoenberger. Thanks again for joining us on Buy, Hold, Sell. We'll catch you next time. Take care.
Buy, Hold, Sell, brought to you by CrossCheck Management.
I want you to smash that like button.